Okay, listen up everybody. I'm going to keep this one very straightforward and very simple for you to understand. Technical analysis. Every retail trader thinks they're an expert on technical analysis. But it's very, very obvious from looking at retail trader statistics that no one makes money from it. 90% of retail traders lose 90% of their money within 90 days. Get used to it. Remember that quote. Every retail trader thinks they're an expert in technical analysis, but no one ever makes money from it. Get used to that. Remember it. TA has a place. Its place is in the gatekeeping process as part of an overall systematic process, and the gatekeeping process is used for timing fundamental ideas. Technical analysis doesn't generate ideas. It helps you to time trades as part of an overall professional systematic process, and its importance is in the minority of the overall process. Allow me to explain further. Let's go over to the computer screen and I'll see you at the end for a recap. Okay, so welcome back to the computer screen. Now we're going to look at the second step in our overall gatekeeping process. We're going to look at technical analysis. Now, we need to remind ourselves first the gatekeeping process, what it's all about, in order to understand fully where technical analysis actually fits into the overall systematic process as used by professional traders and hedge fund managers. So gatekeeping, as you may recall, is the exercise of putting a barrier between your ideas as a trader and your real capital. So if you recall, in the overall process, we have our idea generation phase. This produces our ideas in Forex. Then we have a stage of gatekeeping, which is to time these ideas better. And then we overlay this, once these positions become real positions, with risk management. And when we've traded out of these positions and we've either made a profit or a loss, we then have our self-awareness statistics or trader metrics in order to measure our performance. And technical analysis is part of the gatekeeping process. Retail traders often get this very wrong and think that technical analysis is a tool for generating ideas. It's not. It's part of a timing mechanism in order to time your fundamental ideas better. And the main reason why we have a gatekeeping barrier is because everybody thinks when they produce an idea that all of their ideas are great. It's only very human to assume this, because you may have spent a ton of time generating your ideas, and then you believe at that stage all of your ideas are really good and you've fallen in love with your ideas, and you go and put the trade on straight away, and then you might be stopped out. What do we mean by stopped out? Well, we'll come on to this more in risk management later, but essentially you've, for example, bought a currency pair and you've decided if it trades at a certain level below the price that you've bought it, you're just going to trade out automatically. Basically, a great idea can be mistimed and you can get stopped out and lose money. And this is the worst thing as a trader that you can do. It's the worst feeling in the world. When you have a fundamental view, for example, to go long, and then you're proved to be right in the long term, but in the short term, you get stopped out, or you trade out at a lower price and you just lose money. Now, when you actually have a bad idea and you're wrong and you lose money, you obviously haven't missed an opportunity. You're just wrong. So imagine if you buy a currency pair straight away, it goes down, you trade out, and then it goes back up again. Well, in that situation, you've got a good idea and you've been stopped out, and there's probably no worse feeling in the world if you've been proved to be right, but you lose money. With a bad idea, if you have a gatekeeping process, then you may avoid the trade altogether. So instead of buying it, then being stopped out and losing money, and it just continues going lower, with a gatekeeping barrier, you may have never actually gone into that position in the first place, because by having the barrier, it stopped you putting the trade on. So what we're trying to do here is stop ourselves from putting good ideas on that are mistimed, and then we're proven to be right in the long term, but we actually end up losing money, which is the cardinal sin, or just putting on bad ideas altogether. And this is why a trade idea is treated as an idea only at this stage. It's not yet a trade. We don't fall in love with our ideas. What we have to do is apply technical analysis and price action indicators in conjunction with our commitment of traders reports to stop us doing anything stupid, so mistiming a good idea or getting into a bad idea, period. So a potentially good trade is not just what you think is a good idea. Now, you've just got to make sure that you get the principles here of where technical analysis fully fits in to a professional trader, hedge fund, systematic process. Because in the retail trader market, often perpetuated by people with conflict of interest, technical analysis is confused with a tool that provides trading ideas or themes. Technical analysis doesn't give you ideas. The vast majority of technical indicators follow the price of the asset anyway, and are therefore backwards looking in nature. And some even claim to predict the future using historical data or past price movements. Now, it's not obviously a useless tool. It does have its place in an overall systematic process, but to simply rely on it to give you trade ideas is completely flawed. As too is relying completely 100% on fundamentals. We obviously have to use both, but we have to understand where they both fit in to an overall systematic process. Fundamentals generate your ideas, and ideas are just ideas unless they're timed correctly. So we have to use the fundamental idea generation process, get our predisposition, and then use the gatekeeping process to time our trades better. And technical analysis is just one part of the gatekeeping process. And as we mentioned earlier, the 80-20 principle of spending 80% of your time and 80% of your resource and energy on fundamentals, generating the ideas, and 20% on your gatekeeping process. So technical analysis is by far in the minority of an overall systematic approach. So don't confuse this as a retail trader with a tool that generates ideas. Ideally, what we want to be doing is committing capital, deploying capital to ideas that agree with our fundamental views. And they stack up fundamentally and technically and from a price action perspective. So they stack up fundamentally and they stack up from a timing perspective. So technically and from a price action perspective. So we're looking at our commitment of traders reports. We're working out whether technically in the commitment of trader reports, our idea stacks up in terms of timing. We're using technical analysis in terms of timing and price action for timing as part of a gatekeeping process. What we want is all the planets aligned, so we're basically stacking the odds further in our favor. Now, when you're applying technical analysis, it's always good to have a system in the back of your mind as to how you treat technical analysis, and when you pull up a chart, what it actually says to you, how you actually decide whether you're going to deploy capital to an already fundamental idea, fundamental predisposition. And a good way of thinking about it is to think of TA as a traffic light system. So, for example, let's say you have a fundamental predisposition that you want to be short Aussie dollar, US dollar, as we have in our example running through the video series. And when you pull up the chart, you realize that your idea, although you think it's good, the timing is probably wrong. So, for example, the trend is looking against you at this moment in time. Now, obviously, you don't then go long Aussie dollar, US dollar, because your fundamental predisposition is short. What you probably do here is just don't trade. It's always an option not to have a position. You just don't trade. And you keep your idea on what we call your watch list. Your watch list is a list of all the fundamental ideas of whether you want to be long or short as a fundamental predisposition. We're going to be coming onto watch lists soon when we look at price action. What about if you are in that situation where you're looking to be short Aussie dollar, US dollar, and when you pull up the chart gives you a signal which says your timing is looking very, very good, and your fundamental predisposition as short, now the timing is right. So basically your idea is good. So you always think your ideas are good. Of course, that's just the way everybody thinks. Your idea is good, and technically the price action and the chart is in your favor. So for example, if you have a trend or breakout or breakdown in the chart, well, in this situation, you need to think of this as a green on the traffic light system, and you look to trade, you look to commit capital. And what about somewhere in between? So let's say you pull up the chart, you want to be fundamentally short Aussie dollar, US dollar, and your idea looks from the chart like it's starting to play itself out, but it's not very convincing. Well, for example, this could mean that the trend is starting to turn and it may or may not continue. Well, this is a situation where you could potentially consider trading. So we look at it as an amber on the traffic light system, and you keep this one on your watch list and maybe take a half position or starter position in the trade. So you don't go up to your full position size, you put on a small position. So we're going to go on to gross exposure limits later and position limits later within risk management to see what that really, really means. But a half position or starter position is one in which you have an intended full position size when you feel that your fundamental idea is completely right in terms of timing, and also it's actually a position that's winning or paying and you're making a profit on it. That's when you actually go in and have full positions. But when you're not convinced fully, you're basically having a starter position or half a position. So you need to think of this in terms of a traffic light system when you pull up charts. Do I trade or do I not trade? Or do I consider trading? So the traffic light system gives us a simple way of breaking things down. Now, I just want to highlight here, again, some of the big mistakes that we want to avoid when we're using technical analysis. The big mistakes retail traders make all the time. The first one is getting a trade idea from a chart. Getting a trade idea from a chart and then working backwards. Then using fundamentals to justify it. you basically haven't done the work properly. You've done it the wrong way round. You've been lazy by looking for a chart to give you an idea and then seeking out confirmation bias, looking for fundamentals to justify it. This is a very, very lazy approach, and you're just going to get found out. You'll either get found out by the market and you'll lose money, or eventually you'll just get found out by professional traders if your objective is to go and work in the industry and they're critiquing your processes. So one of the biggest mistakes, getting a trade idea from a chart, then using fundamentals and confirmation bias to justify it. You just haven't done the work. It's lazy and you're going to get found out. Next one, going short of an asset that you're fundamentally bullish of because the technicals short term are looking bearish. We've been through this and it's one of the stupidest things you'll ever do. Imagine you get to this stage, you're fundamentally bullish of a currency pair. You believe that the currency pair is going to go up over a 6 to 12 month period. You're looking for that big 10-15% move over a 3 to 6 month period, or even a 1 to 3 month period. You pull up the chart and you go short and then you lose money. That's just pure idiocy. If you were doing that on a trading desk in a professional trading environment, your boss would literally fire you. You'd be let go. And this is something that doesn't occur very, very often in the professional world because everybody knows the process that they have to stick to. Retail traders are very easily convinced in terms of changing their mind when they pull up charts. The chart is just a pictorial representation of the fundamentals to this point in time. And it's used as part of an overall systematic process to enable you to time your trades slightly better. The opposite also holds true. So going long an asset that you're fundamentally bearish of because the technicals look bullish in the short term. So you have a fundamental predisposition that you believe the currency pair will go down in the next 1 to 3 months by 10%. You pull up the chart, things don't look bearish on the chart, and you decide you're going to go long, and then it goes down and you lose money. Again, pure idiocy. That's dumb money, retail trader behavior. It's awful. It's again something in the professional world that you'd absolutely be fired for. So understand where technical analysis fits into an overall systematic process and see charts for what they are. The charts are just all the price data that we've been looking at in the past, represented pictorially. And we need to use it in the right part of an overall systematic process. Now back onto fundamental predispositions. I just want to highlight this overall process again. So there's absolutely no confusion as to where technicals fit in a professional trading systematic process. You have your fundamental predisposition of bullish or bearish, and technicals are there for timing and timing only. Technicals do not give you a trade idea. Don't let a chart of past price action change your mind. We've realized why now, because if you lose money because you've gone the other way to your fundamental predisposition, because you've pulled up a chart and you've seen short term that it looks like it's going in the opposite direction to your fundamental predisposition, and you lose money, it's the stupidest thing you will ever do as a trader. Technicals can also be used to tell you what you probably shouldn't be doing, just as much as what you probably should be doing. So when we looked at the traffic light system, we know at this stage we have our fundamental predisposition, and we have a red on our traffic light system, a don't trade. Technicals therefore tell you what you probably shouldn't be doing. So if your fundamental predisposition is you want to be long a currency pair, and you get to this stage where you pull up the chart and it looks like short term it's going to go down, then don't trade. The technicals are telling you that you probably should just wait. So they're telling you just as much as what not to do as what you probably should be doing. So when the technicals are going in your favor. So you need to look at this both ways. They tell you to trade, and they also tell you not to trade. They can also allow you to look at the chart and be confused. So you're not exactly sure which way to go because of the timing. Of course, in that situation, if you're not feeling fully confident, you don't have to trade. It's always an option. But you might decide to put on a small position because of your fundamental predisposition at this stage. So going into our technical analysis checklist, what are we actually going to be looking at? Well, we're going to be looking at a 14-point technical checklist. And the beauty of this overall process is that if you think you're an expert on technical analysis at this stage, you can actually add more indicators into this part of the overall systematic process. What's important, first of all, is the overall process. And secondly, the technicals that you're using is that you actually interpret them correctly. So you can add more technical indicators if you want to this area of the overall systematic process and to technical analysis within the gatekeeping process. So first of all, we're going to be looking at trending pairs. So whether we have upward or downward trend. We're going to be looking at ranging pairs. So undervalued or overvalued currency pairs. We'll be looking at reversals, continuations. We'll be looking at volume. However, volume we've actually already covered in the commitment of traders reports. So we won't cover it here. Commitment of traders reports covers volume because it covers the financial futures contracts and the activity of those financial futures contracts. So when you want to cover volume, you just go back to your commitment of traders reports. And we're going to be looking at momentum indicators. So we'll be looking at RSI and simple moving averages. So the first technical analysis indicators we're going to be looking at for timing purposes are trending pairs. And what we're seeing here, if you pull up a chart like this, is a trending currency price upwards. What we've got is more demand than supply in the market, and buyers are paying ever increasingly higher prices. Now this basically, when you pull a chart up, if you have a fundamental predisposition that's bullish, this confirms your bullish view. So if you see an upward trend, it's confirming a bullish view, and you would probably get a green light on the traffic light system, and you would be looking to commit capital. Subject, of course, to our other technical analysis checks of our overall checklist. But as stated earlier, the technical analysis and the way we look at it within the gatekeeping process, in the way that we know its place in an overall systematic framework, the technical analysis indicators can also tell you what not to do. So if you get a red on the traffic light system, as we looked at previously. So imagine now if you have a fundamental predisposition that's short, and you pull up the chart and you see this on the chart. Well, what this does is actually deny your bearish view. We have an upward trend and a pretty well-defined trend, as we can actually chart a trend line. And buyers are paying ever increasingly higher prices, and the trend is well-defined. What you'd be better off doing if you come into this situation with a fundamental predisposition that's bearish, and you pull this chart up, or the chart looks something like this with an upward well-defined trend, you'd be better off waiting for it to break trend. So if, for example, we were at this stage and it actually broke through the well-defined trend line, or in the future, if it breaks through the well-defined trend line, we can look to go short, because the odds will be better or more in our favor with the tailwind of a technical breakdown of the trend. So a trending currency price upward confirms bullish views and gives the green light to commit capital, but denies bearish views, and fundamental bearish predispositions can be put on the watch list until the technical situation changes in your favor. But what about if we have the opposite situation, where we have a currency pair that's trending downwards in value? So we have a downward trend. Well, we've basically just got the opposite situation as before when we looked at upward trends. We've got more supply than demand in the market, and sellers of the currency pair are accepting ever decreasingly lower prices. And this basically is the opposite to our upward trend in terms of our committal of capital. This confirms a bearish fundamental predisposition and gives us the green light to commit, because we have sellers accepting ever decreasingly lower prices. The technicals are on our side, so the wind is blowing in the right direction. But it also denies a bullish view. So if you come into this situation where you have a fundamental predisposition that's bullish, you'd be better off sticking your fundamental idea on the watch list and leaving it until this well-defined downward trend is broken to the upside. So we have a breakout of the well-defined downward trend, and then you will get a green light to put on, in terms of better timing, to put on your fundamental bullish position. So that basically gives us a full overview of trending upwards and downwards currency pairs. What about if we have a ranging currency pair? Well, how do we interpret it properly in terms of a ranging asset? Well, we have the currency pair here with support for the currency at a value 6, and we have resistance in the currency at a value of 8. So how do we actually interpret support and resistance? Well, whenever the currency pair gets to these levels here, supply outstrips demand, and the currency pair continues to fall because supply, so starts to fall and continues to fall because supply is outstripping demand in the market. And whenever the currency pair seems to get to this level, the 6 level, supply dries up and demand starts to outstrip supply, and the currency pair turns around and we get demand outstripping supply continuously until we get back to resistance levels. So how do we interpret this properly? Well, retail traders obviously look at this in a slightly different way to the way professional traders and we look at things. Retail traders are often looking always to buy support and sell resistance, because they think by looking at past price movements, this is going to tell them what to do in the future. Well, what if you short resistance and it breaks through resistance? And that's the only information you've got in a currency pair, which is the past price information on a chart. And that's how you're making your decisions. Well, you can actually go and short resistance, it breaks through and then actually falls back through again and you get stopped out. What can also happen, obviously, is you short it on resistance and it just goes through and you continue and the currency pair just continues to go up. And it's going up for fundamental reasons. So obviously it's a very one-dimensional, stupid thing to do in terms of trading. If that's how you make your decisions on whether to take positions, it's just slightly educated gambling. What about if you are a momentum player and you decide, if it breaks through, I'm going to buy it. If it breaks through resistance, if it breaks through support, I'm going to short it. Well, you've got no fundamental predisposition, first of all, so you're just shooting in the dark. And you're looking at past price information as some sort of guide for future information and taking positions on it. If that's the way you're making decisions, then obviously that's gambling as well. So what can actually happen is you go and buy it, and actually the person who was selling it previously here has put a small order in the market to sell, to remind themselves to sell it at 8 when it gets there. They've got 2 hours in the morning off work, and for 2 hours it goes through. You think you're some sort of hero because it's now broken resistance, and then the seller comes into their office and decides, okay, the currency pair has got to 8 now, I'm going to sell it. And then it just goes straight back down. You can always make the argument that if it breaks out on volume, I'm going to buy it and run it. And if it closes above there at the end of the week, I'm going to buy it and run the position because it's then officially broken out. But it's obviously a very one-dimensional way of deciding how to take positions and deploying capital, and it's just lazy. Because if you can get the data, which is all publicly available information out there on the internet, as we've shown you, and it's free, you can quite easily, if you've got the time, get fundamental predispositions and use technical analysis in the correct way, which is to time fundamental predispositions. So the way we read this is that someone in the market thinks it's undervalued as a currency pair at 6, and someone in the market thinks it's overvalued at 8. And the point is this: the valuation they put on a currency pair is all based on past information, so past fundamental information. If we have a fundamental predisposition to go short here, and it's at resistance and it turns, we might want to take a starter position because it's ranging. So if we're turning here, it shows that there's a range or potential range in place. We take a starter position, and if it doesn't break down through support on the next move, then we're just keeping our starter position and waiting for that to break down. If we have no position and we're looking to initiate and it does break support, then we're looking to commit possibly to a full position there. If we're the opposite, we use the same principles. If we're bullish on the currency pair and we see the range put into place and we see it bounce off support again, we may take a starter position on the way up. If it breaks through resistance, we may add to that position because we're now winning, we're making money, and also the wind is blowing in the right direction. We have the momentum. If we haven't taken a position and we're looking to initiate and it breaks out through resistance, we may commit fully to that trade. But we have to have our fundamental predisposition before. Now, the opposite holds true. Let's say you're bullish, you have a bullish predisposition, and you see the currency pair turning in a pretty well-defined range, coming off resistance. Well, you'd be silly to have a starter position there. So it's denying your bullish view in terms of timing. So you stick it on the watch list and you wait. If it comes down here to support and it breaks support, you stick it on the watch list and wait. And if you're bearish, the opposite holds true. If you see from a well-defined range and your fundamental predisposition is bearish, a bounce off support, you'd be pretty stupid to take a starter position here. You'd be better off waiting till it actually came off resistance, as we mentioned previously. And additionally, if you have the fundamental predisposition and it's breaking through resistance, you'd be better off not trading. So both these scenarios are actually confirming or are actually denying your bearish view. So in these situations, you get a traffic light red and you're sticking them on the watch list and you're waiting for better timing to enter your fundamental short on the currency pair. So you can see ranging stocks, we don't look at this in the one-dimensional way where we're saying, okay, we're not using any information in the world except past price information, and we have a ranging currency pair and we're going to sell at resistance and buy at support because we know that it's a one-dimensional approach and we can easily get stopped out, and it's just slightly educated gambling. You don't have any other information. So you're taking a punt. That's basically what it is, a punt on past price information. The way we do things is we have our predisposition first, and we use common sense. We look to take starter positions on the turns of support and resistance, and we look to take full positions on breakdown through support and breakout through resistance. So it's just common sense. So that pretty much covers how we interpret resistance and support in the overall technical analysis and gatekeeping process. What about now when we start looking at reversal patterns? So our first reversal pattern is a head and shoulders. So this head and shoulders, why we call it a head and shoulders is because in this pattern, which comes up a lot in financial markets, it's very, very common. We have a shoulder, our left shoulder, our right shoulder, our head, and what we call a neckline. Now, if you have a fundamental predisposition that's bullish and you pull up a chart and this is what you see, and let's say, for example, we're here. So everything to the right of here now no longer exists. Let's say we are here and we've seen a left shoulder, a head, and a right shoulder, and our neckline has now become broken. Well, what this means, if you have a fundamental bullish predisposition, is it's denying your bullish view. What it is actually doing is confirming a bearish view on a currency pair. So in this situation, if you have a fundamental predisposition bullish and you see this here breaking the neckline, you wait, you stick it on the watch list. You're going to get a better opportunity to buy the currency pair. That's the most likely scenario. If you come into this situation and you have a fundamental predisposition that's bearish, this confirms your bearish view and you commit capital. This is no longer a trade where you're thinking about deploying capital. You're actually now committing short, and this becomes a real position in the portfolio. What about now if we have the opposite of this? So our second reversal pattern, a reverse head and shoulders. So we're looking at a head and shoulders that's actually upside down. So we have our left shoulder, our right shoulder, our head, and our neckline. And we come into this situation with a fundamental predisposition that's bearish. Well, if we're here and we've seen this technical analysis in the past, and we see this reverse head and shoulders pattern with a neckline that's being broken to the upside, if we have a fundamental predisposition that's bearish, this is a red on the traffic light. It's a don't trade. We stick it on the watch list and we wait, because the most likely thing to happen is that we're going to get a further appreciation of the currency pair and we're going to get a better chance to sell it. If we come into this situation with a fundamental predisposition that's bullish, this is what we want to be seeing. This is a green light for anyone that's bullish. So we look to buy the currency pair and we look to commit capital. So the trade is now coming off the watch list and we're now deploying real capital, and this now becomes a real position in your trading account. So these reversal patterns, head and shoulders, whether it's a standard head and shoulders or a reverse head and shoulders, as in this case, you just need to understand how to treat these reversal patterns, because they are pretty common in the financial markets. You'll see them cropping up a lot in the currency markets, and you just need to understand how to interpret them properly and know what to do in terms of your action given your fundamental predisposition. Now, moving on to our next reversal pattern, number 3, this is a double top, and in this case, a double top breakdown. So we have a double top in the currency pair. So the currency pair has put in a double top at the 11 level, and then it's broken down. So it's broken through previous support. So this is a very similar analysis to our range trading currency pair that we were looking at earlier. Basically, the currency has hit resistance at 11 2 times and then broken support. This obviously confirms our bearish view, but denies a bullish view. In this instance, we have a reversal pattern where we have a double bottom, but then we have a failed breakout and a breakdown. Basically, the currency pair has found support twice at the 7 level here. It's broken out, but then failed to continue to break out. So the breakout has failed. Now, in this instance, if you come into the chart and you open it up and it looks something like this, if your fundamental predisposition is bullish, then this obviously denies a bullish view. But it also denies a bearish view, because the currency doesn't have any technical direction. So there will be instances where you won't be able to do anything, whether you have a bullish predisposition or a bearish predisposition. Again, this is about interpretation and knowing what to do given your fundamental predisposition, and always keeping the traffic light in the back of your mind. So red, don't do anything, watch list. Green, commit capital. Amber, possibly trade. Maybe have a starter or half position and add to it later when there's significant technical direction. So one could argue that maybe you have a starter position here. Again, this is slightly subjective in that it's just common sense. If you're very confident in your fundamental predisposition, then in this situation, having a small starter position or a half-size position could be an option. But it's overall definitely denying a bullish view and denying a bearish view. However, we may look to trade on a starter or half position. But in these scenarios, it's more likely we're probably just going to stick it on the watch list and wait. We will wait for a better entry into the short. So reversal patterns are pretty common in currency markets. Again, you just need to know how to interpret them and how to treat them given your fundamental predisposition. Now, what about continuation patterns? Well, continuation patterns are fairly straightforward. Here we have our first one, a bullish flag. And the way this works is overall we have an uptrend. So you can see this currency pair has gone from 5 up to 1150. So the overall trend is the currency pair is going higher. However, as it's going higher, we have a pause in the price before it breaks out and continues. That's why it's called a continuation pattern. These are also very common in currency markets. And the two things you need to be looking for here is the channel that it's put in and the breakout of the channel, but also the high of the channel itself. So this is the dashed line. If you see these patterns and you come in with a fundamental predisposition that you're bullish, a breakout from the channel is favorable to take a position, and a breakout through the high of the channel, the previous high of the channel, is also favorable to add to the position. Again, if we come into this with a fundamental bearish predisposition, if we see this and we're around this point here and it breaks out to the upside, breaks to the upside from the channel, we'd be stupid to short the currency pair on this breakout. We'd be better off waiting for better timing and trying to short at higher prices. Also, if we're in this position here and it's breaking out through the previous high of the channel, we'd be better off waiting for higher prices. So this continuation pattern, as we see it, depending on where we are in the moment in time, generally confirms bullish views and denies bearish views. Now what we have here is our second continuation pattern, which is a bullish pennant. And a bullish pennant has got the same theory behind it as a bullish flag in the previous example, except the currency pair doesn't range downwards in a channel. It converges as a triangle and then breaks out. So we treat it in exactly the same way in terms of having our fundamental predisposition and confirming or denying bullish or bearish fundamental views as the bullish flag. We treat it in exactly the same way, except when we see these patterns, we know that it's a slightly different setup. So we term this as a pennant rather than a flag. So the two most important areas that we have to look out for are the breakout of the pennant here and the breakout of the high of the pennant here. So we treat it in exactly the same way. If we come into this situation with a fundamentally bullish predisposition and we see a breakout of the pennant, this confirms bullish views. If we see a breakout through the previous pennant high, that confirms bullish views. And the opposite for fundamental predispositions that are bearish. If you see this situation, it denies a bearish view. And if you see this here, a breakout through the previous high of the pennant, that denies bearish views as well. So again, you just have to interpret this properly. So you should always treat bullish flags and bullish pennants in the same way. Now we move on to continuation pattern 3, the bearish flag. This is basically just the reverse of a bullish flag. So our first continuation pattern, we have an overall downward trend in the currency pair from 9 down to 1. And as the currency pair is going down in the overall trend, it pauses and trades within an upward sloping range before it breaks down and continues. So if we're here, for example, and we have a bearish predisposition and we see the channel break to the downside, this is a green light for us on the traffic light. We're looking to commit capital here. Also, our second most important area is the low of the flag in the bearish example, the low of the bear flag. If we see at this time the currency pair breaking through the level of the low put in previously within the channel, this is also a green light. So if we already have a position and we have a fundamental predisposition that's bearish and we see this, we're probably adding to the position. If we don't have a position, we're probably initiating. Now, if we come into this situation with a bullish predisposition, we see either of these, this is a red, we're not trading. So overall, the bearish flag confirms bearish views, but denies bullish views. So if we were to guess what our final continuation pattern is, it should be fairly straightforward. Yep, you've guessed it, it's a bearish pennant. And a bearish pennant obviously has the same theory behind it as a bearish flag, except the currency pair doesn't trade in an upwards range. It converges as a triangle and the trend is downwards. So the overall trend is downwards and we have our two key areas again, the breakdown in this instance from the pennant itself and breaking through the low, the previous low put in when the pennant started. So we have our two areas here and this either confirms or denies bullish or bearish fundamental predispositions. So we treat it exactly the same as a bullish flag. It just looks slightly different. Now we move on to our first momentum indicator, the relative strength index, or RSI. The relative strength index, RSI, measures the speed and change of price movements. So when we're measuring speed and change of price movements, we're measuring momentum. And it's a technical favorite of many retail traders, but the interpretation is actually not mathematically calculated properly because when you look at the mathematics behind it, you realize that just because an RSI is high or low doesn't actually mean sell or buy. You have to interpret this correctly. Now the RSI oscillates between 0 and 100, so on a scale of 0 to 100. And when a currency pair has an RSI above 70, it is said to be, open quotes, overbought, close quotes. And when it's below 30, it is said to be, open quotes, oversold, close quotes. Now, very strong price movements are usually associated with strong fundamentals and or panic and irrationality. That's where momentum tends to come from. And the RSI argues that if the RSI reverses, momentum is coming out of the move. But what you have to remember with the RSI is that the actual calculation doesn't mean the asset has to go down if the RSI is in overbought conditions, or has to go up if the RSI is in oversold conditions. Because an asset can go up very quickly in terms of speed and change of price movements, so in terms of momentum, and it can continue in the same direction, but at a slower pace. So you have to treat the terms overbought and oversold with caution, because RSI can stay high or low, but a currency pair can trade sideways or even keep moving in the same direction, but just the speed slows down. So don't take overbought and oversold to mean that you should now buy and now sell. It doesn't mean that at all. It just gives you a snapshot of momentum. So momentum is important overall because it can confirm or deny our fundamental findings. So for example, we might be foolish to think our idea is well timed if we're looking to enter a long position when the RSI is in overbought conditions. So remember, overbought is always in quotations, oversold is always in quotations. So in the situation where we have a fundamental bullish predisposition, if the RSI is at overbought or in overbought conditions, we might be foolish to think our trade is timed well. So in that scenario, we might consider not trading, and vice versa if we have a low RSI and we have a fundamental predisposition to go short. So again, the way we interpret these things is pretty important. So if we have a look at the formula behind RSI, RSI is simply 100 minus 100 divided by 1 plus RS, where RS is relative strength. And relative strength is the average of the X days of up closes divided by the average of X days of down closes. Now you can look at this further online in your own spare time if you want to. Most commonly, X is 14, so 14 days, but you might consider using X as 24. The reason for this will become apparent when we look further into moving averages, which is another momentum indicator. But the message to take here is that just because an RSI is above 70 doesn't mean it's actually been overbought, because by calculation and definition mathematically, the asset doesn't have to go down. It just means that it's gone up quicker than it can continue going up, and it might go up a little bit slower. But the point is here that it can continue going up, or it might just go sideways. And the same if we have an RSI below 30 and it's said that the currency pair is oversold. We need to know that that term doesn't actually mean it's oversold and we should buy it, because it measures momentum. It's got to oversold conditions because the currency pair has gone down quickly, so the momentum has been quick. It doesn't mean that it has to go up. The momentum can come out of it and the RSI can go down, but the asset can actually still go down or even trade sideways. So you have to interpret these things properly. So if you want to spend a little bit of time going online, having a look at this formula and working it out properly, be my guest to do so. You'll see that this is the case. The relative strength index measure, the RSI, when we consider it as a technical analysis indicator in our overall systematic process, actually ends up being useful more times to us as a technical analysis indicator that denies our fundamental predispositions rather than confirming. So we're looking for timing always in the gatekeeping process. We're using technical analysis indicators, and this particular indicator, the RSI, it basically might put us off short term from putting a position on if we see the RSI in overall overbought or oversold conditions, and we might just wait for a slightly better price point. But The key here is obviously understanding that momentum may come out of the currency pair when it's overbought or oversold, but it doesn't mean it has to go in the opposite direction. It can still go in the same direction, but just slower or trade sideways. So we're going to move on to our next momentum indicator, number 2. We're going to look at simple moving averages. And here, many of you might actually want to look additionally at exponential moving averages. That's totally fine. The same theory applies. It's just how we treat momentum indicators and how we treat moving averages. The beauty, obviously, of having an overall systematic process and knowing where technical analysis fits in the overall process, as in within the gatekeeping process for timing, is really the key. You can add any amount of technical indicators if you want to your overall process, but the key is just getting the overall process correct and knowing where technical analysis fits in. So if you want to stick in exponential moving averages here, that's totally fine. You can stick in anything. But let's have a look at simple moving averages. Moving averages overall indicate whether momentum is slowing or rising in a currency pair and whether momentum might be turning in a given pair. So a simple moving average, or SMA, is an asset's average price over a given number of days, and it actually trails the real price. So let's say, for example, we have 10 days of price data where a currency pair is trades at 6, 5, 6, 7, 9, 8, 8, 10, 13, 16. Well, if we take the average of all of these, the 10-day moving average is 8.8. But if we take the average of the last 3 days, the moving average is 13. So if we were actually to stick this on a chart, if we plot them both, so a 10-day trailing simple moving average and a 3-day trailing simple moving average, if we chart this, in this instance, what's going to occur is the 3-day moving average will cut the 10-day moving average from below. And this, as an interpretation, indicates positive momentum is building. And with our fundamental predispositions of bullish and bearish, we should be starting to understand what that means. If we see a short-term moving average crossing a long-term moving average from below, and we have a fundamental predisposition that's bullish, this confirms bullish views. If we have a fundamental predisposition that's bearish, and we see the same thing, this denies bearish views. And vice versa, if a short-term moving average cuts a long-term moving average from above. This is a bearish signal, therefore confirming bearish fundamental predispositions and denying bullish predispositions. Now, when it comes to moving averages, they can be quite popular in the retail trader market. Just remember that obviously average price is trailing the actual price, and that the price of an asset is the most important thing. The average price is trailing it. You may have also heard with moving averages a couple of sexy sounding phrases in the financial markets where basically moving averages are given some sort of significance. So they become significant factors of consideration when trading. The phrases that are most commonly used in the financial markets are, for example, a golden cross when a 50-day moving average crosses a 200-day moving average from below. Or we have another one which is called the death cross, and that's when a 50-day moving average crosses a 200-day moving average from above. So these are very popular things to look at, especially in the retail trader market. And the market also focuses on 100-day moving averages. So you're always going to be told that the most important moving averages in the market are 50, 100 and 200-day moving averages. and that the golden cross and the death cross are significant when it comes to momentum in a currency pair. But why? What is the significance of 50 days, 100 days, and 200 days? Why not, for example, 49 days, 99 days, and 199 days? Why is 50, 100, and 200 important? What does it mean for currency markets? Well, it's actually a trick question. There is no significance whatsoever. The Forex market trades for 6 days a week. These numbers are completely arbitrary and pushed and perpetuated by market participants with conflict of interest in order to make people trade. There's 6 days in a week for currency markets. So let's have a look at the numbers that really matter for moving averages. The Forex market opens in New Zealand at 5 p.m. Eastern Standard Time, so New York time, Sunday afternoon, and closes at 5 p.m. EST, Friday afternoon. And in New Zealand at this time, the time is 10 a.m. on Monday morning, and it trades till 10 a.m. Saturday morning. So we've got 6 days of currency data per week. And if you download data on currencies on a daily basis, so you get daily data, you'll see each week when you download it includes 6 days. When we look at these times in London it's 10 p.m. on a Saturday night when the currency markets open, and they close at 10 p.m. on Friday night. So those hours are a bit more friendlier in terms of making it possible to trade Forex markets during Asian, European, and United States hours. But the point here is that we have 6 days to trade the Forex markets each week. So the most important moving averages are actually in multiples of 6. 50, 100, and 200 day moving averages are just totally arbitrary numbers. They just sound good. They don't mean anything. So when we look at 1 week in the Forex markets, we have 6 days. When we look at 1 month, we have 24 days. When we have a look at a quarter, we have 72 days. And when we have a look at a year, we have 288 days. So why are these actual time periods important to us? Well, first of all, we have to get it right that 6 days as a multiple is the most important thing in the currency markets. So that's 1 week. 24 days is 1 month. And this is important because at the end of the month, we have institutional options hedging and expiry, and we have asset manager and hedge fund reporting. So asset managers and hedge funds report on a monthly basis. They report their returns. So 1 month, 24 trading days is important to our analysis. 72 days, as in 1 quarter, 3 months of the financial year. 72 trading days is therefore important to us because it's a quarterly reporting period. We have institutional options hedging and expiry, and we have corporate reporting. So we have companies reporting earnings, and they're very active in the Forex markets with hedging. And we have quarterly and monthly asset manager hedge fund reporting. So 3 months is important to us. 72 days. That's 72 trading days in Forex. 1 year is important to us because we have institutional options hedging and expiry. That happens every month anyway. But we have corporate earnings, again, because we have annual earnings. Corporates are obviously active in the Forex markets. They have annual earnings and they may be hedging at the end of each year. So we also have asset manager and hedge fund reporting on an annual basis. So 1 year is important to us. Therefore, 288 days as a multiple of 6 days per week. 288 days is our important moving average in terms of looking at a 1 year moving average. So what we need to look at here is moving averages of 6 days, 24 days, 72 days, and 288 days, because these are the most important numbers to us. So what we need to look for example, is when a 6-day moving average cuts a 24-day moving average from above or below. What that's doing is signifying on our time frames a short-term trend. On our time frame of 1 to 3 months, when we look at a 24-day moving average cutting a 72-day moving average from above or below, this signifies a medium-term trend. And when a 72-day moving average cuts a 288-day moving average, so that's the 3-month moving average cutting a 1-year moving average from above or below, this signifies a long-term trend. Now, running parallel to our opportunities analysis, our idea generation, and our risk analysis, so using daily, weekly, and monthly data. This is exactly why we only use daily and weekly charts, complemented by daily, weekly, and monthly technical analysis. So if you remember, right at the beginning in the foundation of the video series, we were looking at daily volatility, and we were looking at weekly and monthly volatility. And we got to our optimal 1 to 3 month time horizon. And if we want to look at volatility in this way, then we're not obviously looking at hourly charts. We don't want to look at a 1-day chart and look at, or look at 1 week and look at hourly timeframes. What we need to do is obviously line up our volatility analysis and our technical analysis and make that run parallel to each other. So running parallel to our opportunities analysis, our idea generation, and our risk analysis is us using daily, weekly, and monthly data, daily and weekly and monthly charts. And this is what we do. We line up technical analysis and volatility analysis, and we make sure we're looking at the same thing. So when it comes to our overall analysis of volatility and technical analysis, and we're looking at the 1 to 3 month time horizon on our charts, what we need to do is overlay our long-term charts and have included on the charts our 6-day moving average, our 24-day moving average, our 72-day moving average, and our 288-day moving average. And we look for clues in momentum that's positive or negative in order to confirm or deny our bullish or bearish fundamental predispositions. Now let's have a quick recap before we go back over to the trading desk for a full recap. Gatekeeping is the exercise of putting this barrier between your ideas as a trader and your real capital. A great idea can always be mistimed, and you can get stopped out and can still lose money. So what we need to do is apply technical indicators like COT reports, technical analysis, and price action indicators to stop us doing anything stupid, mistiming a good idea, or just getting into a bad idea, full stop. Now, don't confuse again technical analysis with a tool that generates trade ideas. Stick to your fundamental predispositions. If the technicals are not ready, they're not ready. You just have to wait. You could just be too early. Stick it on the watch list and wait for the technicals to confirm. What we're looking for, so a potentially good currency trade, is one that's a tradable currency pair, so in our tradable set and available on brokerage platforms, with the long side indicating or scoring high inflationary conditions, the short side indicating or scoring deflationary conditions, and the timing is an amber, so a starter or half position, or a green light, full position. That's given by our analysis of the technical indicators, so the COT reports plus TA and price action that we're going to look at now. So a potentially good trade is not just what you think is a good idea. the market has to think so too. We want the market on our side, and we want to time good trades or good ideas correctly. Let's go back over to the trading desk now for a full recap on technical analysis. Okay, so welcome back to the desk. What we're going to do before we conclude and recap everything on technical analysis and where it fits and everything through the gatekeeping process, what we're going to do is go over to the computer screen, and we're going to look at the technicals at this moment in time for the Aussie dollar, US dollar, so the example that we've been using throughout the video series. So we've come to the conclusion to this point that the Aussie dollar, US dollar, both on our endogenous, exogenous overall analysis, is a short bias. We're looking to short it fundamentally as a currency pair. We've entered the gatekeeping process. We've gone through the commitment of traders reports, which are giving us a warning sign that Aussie dollar, US dollar could rally in the short or near term. So we didn't get a green light there, we actually got a red light on the traffic light system. So what we're going to do now is have a look at the technicals and see how the technicals are playing out in terms of timing on the Aussie dollar, US dollar chart, both in the long term, medium term and short term. Then we'll come back to the desk for a full recap. Okay, so what we're going to be doing here is taking a look at the technical analysis of the Aussie dollar, US dollar exchange rate that we've been looking at as an example throughout the overall systematic process as part of now the gatekeeping process. So we're going to be critically analyzing the technicals for Aussie dollar, US dollar exchange rate as part of the overall gatekeeping process and looking at the bigger picture technicals to try and understand if our timing is any good in looking to short the Aussie dollar, US dollar, as our fundamental predisposition is to look to sell this exchange rate. So let's start off with what's on the left-hand side here. On the left-hand side, you're going to see something that should be very familiar to you now. You're going to see the data downloads from investing.com/currencies. The first thing we have is the date. So we have data going back to September 2008 all the way up to present day. So what we're looking up to here is actually right up to now May 2015, which is quite important. We'll come back to that later. We've got the Aussie dollar, US dollar exchange rate for each day. So remember now, this is daily data that we've downloaded. We have the open for the exchange rate, the high and the low, and the percentage change of the exchange rate from the previous day. And we've created a whole bunch of charts here using the data. We've got charts going back all the way to the beginning of the data to present day. So this chart here, which is a 7-year chart from 2008 to 2015. We have a 3-year chart, a 1-year chart, and a year-to-date chart. And next to each chart, you'll see some notes that we've made on the analysis of the bigger picture of the technicals that we're looking at when we're critiquing the timing of this particular idea and whether it's going to become a trade and we're going to deploy capital to it or not. So let's start with the big picture. Let's have a look at the Aussie dollar, US dollar exchange rate going back to 2008. So let's look at the 7-year chart first of all. So we're looking at this chart here. So going back to 08 all the way up to present day, and up the left hand side we have the value of the Aussie dollar, US dollar exchange rate. Now on the chart we have our green line, which is the data for the Aussie dollar, US dollar exchange rate. So if you just double click on that, you can see that we're referencing the dates. and the actual value of the exchange rate. We also have these colored lines here. These are actually our moving averages. So if you double click on them, you'll be able to see the periods. So we have our 72-day, we have our 24-day, and here we have a 6-month moving average. We've got our 144-day moving average, so a longer term moving average. You can add a 1-year moving average later if you want to, that's fine. But here we're going to look at 1 month, 3 month and 6 month moving averages. And the first thing we notice is this big move here when we look at the bigger picture. And the big move started down in August, September 2014. And you have to put things into perspective when you're looking at charts, especially longer term charts. So when we look at this big move down here, we have to compare it to other moves down in the exchange rate in the past. So we're looking at moves like this here on the chart. And the first thing we notice when we're trying to get perspective here is that this is the biggest move down out of the 7-year history. Visually, we can see that. So we have to remember that, keep that in the back of our minds. The long-term moving averages crossed or were crossed by the short-term moving average. So in a 7-year data set, a short-term moving average really is 1 month. And you can see the 1 month moving average crossed from above both the 72-day and the 144-day moving average here. So that's something to note as well. We look as well at the medium-term support. So we take note here that we have a medium-term support level that was put in around the end of 2013, and that this is around the 87 level. If you want to zoom in on the data, you can find out exactly where that is. But this is the exercise of getting the big picture right and understanding the bigger scenarios and bigger trends. So we're building up a picture of the Aussie dollar, US dollar here. We notice this support level broken in November. And that's medium-term support on a 7-year chart. Long-term support, we see here. We see that around April, May 2010, this support level was put in by the exchange rate at around the 81 level, and that was actually broken in Jan 2015. So we're picking up a few things here that, you know, if we're looking to go short this exchange rate, we have to take note of these bigger picture moves and understand longer term what the big picture looks like. So we can move on to look at a shorter term chart. So if we scroll down and look at the 3-year chart, what are we noticing here? Well, the first thing we notice is that in the last 3 years, so since May 2012, the overall trend has been down. One thing you can do if you want to work out what the overall trend is very quickly, you can just select the data of the chart. You can right mouse, click add trend line, and you can just plot a linear trend line. And we can change the color here. So let's change this to red, and we can thicken it up. And you can see the overall trend is down. So that tells us something. In terms of technical analysis, this is always a good thing, that if we're looking to go short, for example here, that we get an overall confirmation that the market is actually on our side. However, one thing to note is that over a 3-year period, it's not exactly a situation where we're coming up with a very original trade here. When you look at the in terms of timing, this trend is quite well defined, but it's quite old. You know, we're not getting in at the beginning of a trend here. This is a well-defined trend that's occurred in the past. Now, we have to look at the top to bottom statistics as well, so to get an idea of what we're playing with here in terms of percentage moves. Now, because Aussie dollar US dollar exchange rate is around 1-for-1 in the history of this this exchange rate, using points is a decent guide to percentages. With an overall lower trend, the top to bottom, we're looking at 106 down to 0.76, and we're near the lows here for the last 3 years. So we've got a 30-point move top to bottom and an overall well-defined trend that we're not really early to. It looks like we're coming into this quite late. So there's a 30-point top to bottom move. We have to ask ourselves the question here, have we missed it? Have we missed the best returns of this total trade? Additionally, once we start zooming in, we can see some recent occurrences where we've got a double or triple bottom put in around 76. And when we look at previous rallies, we can see, first of all, we have a rally here that's occurred recently. And when we look at past rallies to compare this, we see, for example, this rally here towards the end of 2013, beginning of 2014. This rally came from around 86 up to 92. So we're looking at a 6-point rally. We're looking here, for example, where we're going from 0.89 up to 0.9596. So it looks like we're getting previous rallies when this exchange rate does rally of around 6 big points. The current rally is from 76 up to around 79. So we've only got a 3-point rally there. So this could be another warning sign overall when we look at the bigger picture as well on the 7-year chart, that we could be looking here at the right fundamentals, so a good idea, but the timing potentially being bad. Now we can look at a 1-year chart, and the first thing we notice on a 1-year chart is that our moving averages have actually changed. So we're looking at more shorter term moving averages now.
So if you look at the lines on the chart, our moving averages, the yellow line is our 6-day moving average. The red line is our 24-day moving average, and the blue line is our 72-day moving average. And what you notice right away in the near term is that the 6-day and the 24-day moving average have crossed recently the 72-day moving average from below. What you'll also notice is that there's some short-term resistance at around the 79 and the 80 level, and medium-term resistance in this entire sell-off in recent history around the 82 level. So if we scroll down now and just zoom in a little bit from the 1-year chart to the year-to-date chart, you'll see that we have a standard continuation pattern that we were looking at earlier, potentially of a bull flag. So we have the rally here from 76 up to the 80 level, and it does seem like the Aussie dollar US dollar exchange rate is bull flagging at the moment. So when we take all things into consideration here, when we're looking at the long term to the shorter term charts, the Aussie dollar US dollar as a potential short, we have our fundamental predisposition, but the timing as far as technicals go looks slightly off. Now if we think about the previous charts that we looked at, we had 6% rallies in the sell-off since 2012. So if we have a look at adding 6% to the low, which was 0.76 in this sell-off, so around here, we're looking at slightly above the 80 level, so 0.8056. So anything above that could be a good entry. So what we're looking for really is around 81 as a potential short, as long as the fundamentals are still in place. But if we do get a rally up to the, say, 82, even 83, 84 region, with obviously the assumption that the fundamentals remain, we will seek to enter a starter position. And obviously this analysis seems to corroborate with what we looked at earlier in the commitment of traders reports with historical lows in the net short positioning. So 81 and above, so the 6% rally off the low could be a good entry point. Combine this with a flip in the COT data, and this could be a really good opportunity to look at short entries. So the Aussie dollar US dollar exchange rate is really at the moment a hold off situation, and we're going to look to sell it at 81 or above, and if we can get away with it, 82, 83, and really, fingers crossed, if it rallies hard, we might even get 84, and that would obviously be even better.
And this is why Aussie dollar, US dollar serves as a great example, because the fundamentals are all in place, but the timing isn't. So you're going to get this a lot throughout your life when you look at fundamentals in currency pairs. So looking at all the economics, everything lines up, and then you get to the gatekeeping process and the timing looks slightly off or totally off. And you've got to be responsible and say to yourself, for example, in this situation with Aussie dollar, US dollar, that if I deployed my capital now, it would probably be irresponsible. So I'm going to be responsible and wait. And retail traders generally don't go into this much depth in terms of fundamentals and combining it with COT reports, technicals, and price action, and not doing it in a proper systematic process. And they end up wanting to trade, so trying to force trades because they sound like good ideas in the news and end up shorting things in a hole. And then they get carried out with moves like this and just get stopped out all the time. Now, one thing we mentioned earlier was the dates. And this is quite important because when we looked at all the fundamentals in the endogenous and exogenous analysis, when we looked at endo for US and exo across Australia and US, all the data we were looking at was up to February, March 2015. When we looked at the COT reports, we were looking at data up to March, April. Now we're looking at data up to May 2015. And this is important to understand. Imagine you were in this situation here in March 2015, and you were looking at being fundamentally short. So your idea was to be fundamentally short the Aussie dollar, US dollar exchange rate. And you pulled up the COT report data and you pulled up the chart. Now, what you will have seen is only up to this point. So somewhere in March. And what's happened? Well, the COT reports have actually told you that you would have been right to wait. And this is why COT reports are so useful, because the net positioning was at extreme lows in terms of being net short. So the language we use is might be a bit confusing. When we look at the net short positioning, the net short positioning was actually on historical highs, but the chart is on historical lows in terms of the net positioning chart itself, the negative number. So that chart is on its lows in the extremes, and the sentiment was so bearish that Aussie dollar, US dollar actually started to rally. And we've seen from we saw that in the COT reports in March, and look what happened. We would have been actually right to sit back and wait. And this is the beauty of having a gatekeeping process with this analysis in it, because over your lifetime, you can save yourself a lot of money, because who knows, Aussie dollar, US dollar being a short could end up being a really good trade, but right now it's just an idea. And if it was an idea at this point and you decided to wait just for 4 to 5 weeks, you could have actually taken a starter position in the high 70s rather than at 76. Combine it with technical analysis, you would have seen a low put in here, a rally, and you would have started to get a little bit concerned that momentum was changing and the COT reports were on their low. So this stuff works, and this is exactly why it's in the overall process at this point in the process and not the other way round. Don't get these things upside down. Don't look at charts and say, I've concluded that there's positive momentum in Aussie dollar, US dollar, so I'm going to buy some, and then try to look for fundamentals to justify the chart and the reason why you've bought something or shorted something. It's the wrong way round of doing things. Because what's going to happen is if it goes against you, you're just going to trade out because you've got no idea really why you have the position on at all. So there's no fundamentals behind it. Deep down in your gut, you know the reason why you've taken the trade is there's no real reason at all. So get it the right way round. Get the fundamentals first. You get your fundamental predisposition, and then you look for the timing. And here, you would have been right to hold off. And we may even be right here to hold off now and look for 82 to 84. So around the 83 mark is probably based on previous 6-point rallies and the technicals that are put in place throughout the history of the data that we're looking at. Around the 83 level is probably the right level to seek to take at least a starter position. And overall, if we take this approach, we're actually going to save ourselves a hell of a lot of money over our lifetime. Okay, let's go back to the desk now and conclude on TA. Okay, so welcome back to the desk. Obviously, we looked at quite a few technical analysis indicators there. We looked at overall 13 in that section. If you want to look at volume, you can obviously get futures contract volumes from places like CFTC, CME. So look for the overall futures contracts on currency pairs. But the best way to look for volume is in the previous section on COT reports, because you see the volume and you see the net positioning of the market. So we looked overall at 13. Our 14th is volume, which was in the previous section in COT reports. But with our list of technical analysis indicators, we did mention that you can add more if you want to. That's totally fine. The list is obviously not exhaustive. What you have to do in a systematic process is just understand the reasons why things are treated the way they are and where they are in the overall process and why. And technical analysis, the most important things from a professional trading perspective is that it's a timing mechanism and it tells you which way the market is looking to go over certain timeframes. So the key is, first of all, understanding where technical analysis applies, and secondly, it's also the interpretation. So you will have noticed as we went through a lot of the technical indicators, the interpretation of many of them is very similar to the commitment of traders reports and the way we read those. In that we're looking at technical indicators telling us whether our ideas are being timed well or not, and giving us the input to our decision-making process as to whether to go into our fundamental trade idea now, or wait, or even take a starter position. So we get idea refusal and idea agreement. So again, this is another part of the gatekeeping process, technical analysis, where we're being told as much as what not to do as what to do. So the two things to really take from this are where it fits into the overall process and the real interpretation of how you actually use it as a tool to decide whether you're going to deploy capital or not to a trade. Not the other way round, which is what all retail traders seem to do, which is pull up a chart, get an idea from it, put on a trade, and lose money. Because there's no fundamental input or understanding of what's going on. And I think, one of the big points here, out of the two key points, so understanding where it fits into the overall process is really important to take on board as a retail trader. Just think about the way the retail trader market works. One of the things we mention a lot in our free seminars when we go on the road is for retail traders to develop a more finely tuned, and forgive my French, a more finely tuned bullshit radar. And you can see there the clues that we looked at when we looked at things like golden crosses and death crosses. All of these things have very sexy sounding names, and there's actually nothing in the numbers that means anything behind it. 50-day moving averages, 100-day moving averages, 200-day moving averages, 50 crossing 100, 100 crossing 200, all these lines that you can draw all over a chart and give them sexy names. But if you actually ask the obvious questions, it doesn't actually mean anything. 50 days means nothing in the Forex markets, 100 days means nothing in the Forex markets, and 200 days means nothing in the Forex markets. What matters is the multiples of 6 days, and month end, quarter end, and year end, because we're trading on, first of all, we're trading an asset class that trades 6 days a week. Secondly, we're trading fundamentally over 1 to 3 month time horizons. So what we care about is what the other people in the market who trade on fundamentals are actually doing. So the month end, the quarter end, and the year end. So that's a great indication of, when you look at moving averages, of, as a retail trader, how information is misconstrued or pumped out by people with conflict of interest. It's to get you to trade all the time because they're volume incentivized and they want you to trade as frequently as possible in as big a size as possible. And if you have a finely tuned bullshit radar, you ask the obvious questions. What does 50 days mean? Well, it means nothing, so it's bullshit. So I won't trade on something like that. It's pretty obvious. And in the retail trader market, everybody thinks there's some sort of technical analysis expert. Well, that's great. I love the idea personally that people really want to get into trading, look after their own money, determine their own financial future by managing their own money instead of giving it to a pension manager who's just going to lose it over many, many years or not even grow it. That's all fantastic, but ask the obvious questions. Becoming an expert on technical analysis obviously doesn't work in the retail trader market because everyone loses money. So the retail trader focuses so much on technical analysis as some sort of panacea to enable you to go out there and make millions of dollars in the Forex markets, yet 90% of Forex retail traders lose money. So it obviously isn't a panacea. It's information that's pumped constantly to you, perpetuated by people with conflict of interest. But it's not useless. You just have to understand its uses, understand its limitations, and understand conflict of interest and bullshit. And technical analysis, its uses are that it fits into an overall systematic process within a gatekeeping mechanism between your fundamental ideas and your real capital, and it helps you or enables you to time your trades slightly better. Its limitations are that it follows the price. So the vast majority of technical indicators follow the price anyway. They're backwards looking. They're not really telling you what can happen in the future. It gives you a good idea of what's happened in the past and maybe some momentum that might be playing out in a currency pair. But it doesn't give you any great certainty of what's going to happen in the future. It helps you time things better. And it's one of those tools that just gets perpetuated all the time as a panacea by people in the industry with conflict of interest to basically make you trade, because it's fairly straightforward to understand. Follow this line on a chart. If it goes up through this line, buy it. If it goes down through this line, sell it. Well, if life were just that simple, it would be great, but it isn't. You know, we'd all be sitting in the Garden of Eden and we'd all be billionaires by now if it was that simple. It obviously isn't. People who do that lose money because they don't have an overall systematic process. So understand its uses, understand its limitations, understand conflict of interest and bullshit. Use a decent number of technical analysis indicators as an overall, within an overall process, and put it in the right place within the overall process, within the gatekeeping process between fundamental ideas and real capital. And see it for what it is. It helps you time trades slightly better, but you have to have a fundamental predisposition first and do the fundamental work first. Add more indicators if you want to, that's fine, but you do not need to overdo it. Don't pull up a chart and draw 25 lines on it. It's not going to add value to your overall systematic process. Just get the basics right, get the big picture right, and time trades correctly or as close to optimally as you possibly can by just getting the big picture right in both the fundamental trade idea generation process and getting the big things right in commitment of traders reports, technical analysis, and price action. Just don't overdo it. You get the big things right. Your position sizing, which we'll go on to later in risk management, your position sizing as well, if you get that right because of your overall process, you don't need to worry about all these tiny little details about lines moving and crossing multiple different lines. It's all irrelevant. It's all hocus pocus bullshit. Just stick to the main principles of fundamental idea generation, using commitment of traders reports, technical analysis and price action, and using them to time trades better. So get good trades on at good timing and get rid of bad ideas. Good ideas becoming good trades, bad ideas just not even getting on at all, because the commitment of traders, technicals and price action is all against you all the time. So let's move on to the next video now. Let's go over to price action, and we'll be looking at price action and watch lists. I'll see you on the other side.